Hello and welcome back to our Ask the Expert video series. Today we're going to talk about Japan, why its central bank is the only one not raising interest rates, and what that means for the yen. So, you've probably heard that interest rates are going higher across the world as central banks try to fight inflation. The only major economy where that's not happening is Japan, and there's a very simple explanation for that. There isn't a lot of inflation to fight. The yearly inflation rate in Japan is just around 2.5%, way lower than the 9% in Europe and America. So the real question is, why hasn't Japan experienced inflation like the rest of the world? And the answer is twofold. First and foremost, Japan is aging. The population shrank by 600,000 people last year alone. That's roughly 0.5% of the entire population. It's very difficult to sustain high demand and high inflation when there's fewer and fewer people each year. The other reason is psychology. After decades of deflation and stagnant wages, consumers don't really expect prices to rise anymore, and companies are reluctant to raise their prices, afraid of a public backlash. The deflationary mindset has been embedded into Japanese society, and by refusing to raise interest rates, the Bank of Japan is trying to break this mindset. The goal is to use the global supply crisis to its advantage, import as much inflation as it can, and shock consumers into expecting higher prices, which hopefully kickstarts the economy. But this process requires the yen to suffer. With Japanese rates stuck at zero while foreign rates are rising, capital is flowing out of Japan, seeking higher returns elsewhere. In a nutshell, that's why the yen has collapsed this year. That's it for today. If you have a question, email us at asktheexpert@xm.com. Thank you.